Welcome to Industrial Alliance Investment Management's April's macroeconomic and market update. On discussion today is our investment theme stakes on major market movers of the past quarter and our outlook for the rest of 2022. My name is Rose Marcello, and I'm a client portfolio manager at IEIM. Joining me for this conversation is Dominic Siciliano, Principal Vice President, Public Fixed Income. Dominic is the head of the fixed income strategy for both rates and corporate bonds. Thank you, Dominic, for being here. The bond market has been severely depressed in 2022, and the total return for the first quarter is the worst return ever seen for the asset class, even breaking the record already observed in the first quarter of 2021. What are the drivers of this negative return, and historically, what conclusions can we draw for the bond market?
Thanks, Rose, for the question. I appreciate the time to be with you all here today. 2021, if we go back just a little bit, was a period where central banks provided an enormous amount of liquidity to the marketplace, and we had a large fiscal plan supporting the growth aspects post-COVID. 2022 starts, and we're in a bit of a different environment. A lot of uncertainty brought to you and volatility brought to you by geopolitical risk, the Ukraine situation, the Omicron variant, all the disruption in the supply chains. This has led to another bout of increase in inflation. And to combat this, the central banks have now decided that they need to raise rates to fight this wave of higher prices. But for you, the investor, what does that mean? If you look at the following slide, this uncertainty volatility is driven by two factors. And this is something that's historically always been the case. When inflation and yields are rising, you have asset price volatility. That could be positive in the case of the commodities, but it could also be negative in the case of the bond valuations and on the equity markets. But not everything is doom and gloom for bond investors. If you look at the second slide, and I give you sort of like a small example, and I would like you to reiterate that slow and steady wins the race, especially in the fixed income space. So if you own a 10-year bond that's worth $1,000 with a coupon of 3%, and then suddenly rates go up to 4%, we'll argue that the bond will be valued about $925. So you're saying, well, I've lost $75. It's a mark to market. It's a temporary disruption in the price valuations because rates have gone up. You still will get your $1,000 back unless it's a default, and we don't think it would happen in government securities or the type of portfolio we manage. But you will get your $1,000 back at term. And now the advantage for you is that instead of reinvesting your coupon at 3%, which is the going rate or lower, you'll be able to reinvest your coupon at a higher interest rate. So in a bond portfolio, when you think about all the coupons and cash flows we're getting on a day-to-day basis because of the of all the positions we have in the portfolio, these coupons now are being reinvested at a higher rate. So it's a bit of a short-term pain and revaluation on the bond side. But I think for people that are in the bond market for the mid and long term, this is the perfect time to rebalance your portfolio in a diversified way and to keep your investments in fixed income. And I think that this higher interest rates will benefit, especially retirees who have been suffering with lower and lower yields. This is an opportunity for you to get back some of that yield in your portfolio.
Great. And turning to those central banks, so several central banks have now begun a tightening cycle of their respective monetary policies, and markets are pricing multiple rate hikes by 2023. What is the outlook of the IAM's fixed income team for the asset class, and what would that mean for your investment strategy?
Well, if we look at the following slide too, which I prepared, and thank you to Sebastien McMahon for giving his knowledge to this slide. But if you look at what the market is pricing right now, we're pricing 9 rate hikes, and then weirdly 2 cuts at the end of 2024. So that's telling you that the market is already pricing an overshoot in where Fed policy should be because there's this fear of increased inflation. So a lot of the rate hikes and the news that's in the marketplace is already priced. So we think that we're getting close to a point where being long duration will be interesting, especially in US 10s as we approach the 3% mark. We're at 290 today. I think between 3 and 3.25 is probably an area you want to start thinking about getting back into bonds. So this is another reason why I think it's not the time to throw the towel in terms of your bond investments. Just makes sense with the type of portfolios and the things happening in the market right now. So when we talk about this 2.5 equilibrium point, we think that the markets could probably get if there's any little slowdown in the economy, any other event might slow down this aggressive rate hike scheme by the Federal Reserve. And we're using the Federal Reserve because they're a little bit the world's central bank, and the same thing applies for the Bank of Canada, which is maybe closer to our portfolios. On the credit side, though, another thing that's interesting is that credit is actually underperforming because spreads are widening in this rate environment. People are liquidating some positions. The liquidity is not great, so you're seeing spreads widen. But companies are extremely healthy. So for an active portfolio manager like ourselves, we're able to rotate some of our credit positions into, I'd say, better quality, and now being really well compensated for the credit spread relative to that. So that's another advantage right now in this type of volatility for an active manager, is to say, hey, these names make sense. They're actually in really good fiscal or economic stance. Let's add it to our portfolio, or let's rotate into them. So it's another benefit. So we think that, it's still a bit of a devaluation in terms of the valuation on fixed income, but overall, it's not a bad time to start thinking about fixed income as a mid to long term asset class.
Great. Thank you for your insight.
Thank you very much for your time. Have a great day.